This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
Our mission has two goals. One is to decarbonize commercial real estate, so the more the better. And the second is through how we've approached our lending and how we've achieved the Moody's rating to also be able to add to the existing momentum for the green bond market.
Hi, everyone. The climate transition will require trillions of dollars of investment, but many of the biggest opportunities still face structural financing barriers because our financial system was not designed for a challenge of this scale and complexity. As investors, entrepreneurs, and institutions work to accelerate the transition, there's a growing need for new financial models that can bridge those gaps and unlock capital more effectively. Today, I'm joined by Bob Zulkoski of Conduit Capital, a firm taking a very different approach to climate finance. Rather than build one big fund, Conduit is creating platforms designed to unlock private capital at scale, from financing energy efficiency upgrades in commercial real estate, to launching climate transition SPACs, to developing a new blended finance vehicle aimed at helping impact investment managers bridge what Bob calls the pioneer gap. Bob calls the model radical collaboration, and the goal is not just to invest well, but to prove new models that others can replicate. I learned a lot in this one. Enjoy the conversation. Hope you do too. Hi, Bob. Welcome to Invested in Climate.
Jason, good morning. Pleasure to be here.
Well, great to meet you and great to have you here. I'm very excited for this conversation as you're deploying a set of creative and sophisticated tools designed for real climate finance opportunities today. There's a lot to cover, so let's dive in. The projects we'll discuss are led by your firm, Conduit Capital. Help us get started by understanding the purpose and vision of Conduit.
Thank you for asking that question. The idea of Conduit Capital is built on the two pillars. One, what makes impact investing different than traditional private equity or venture capital is that the participants are more willing and able to collaborate and actually seek to collaborate because there's a mission that brings us together. So that's the first principle. The second principle is that we want to promote the idea of radical collaboration because many of the issues that we're trying to solve require a departure from convention and radically new approaches. And I think that is evident in the various initiatives that we've started over the past few years.
Fantastic. Well, it's a great vision. Radical collaboration definitely needed. Let's go a bit deeper and understand how you're actually pursuing it. What levers are you pulling to activate private capital at scale?
That's also a great question. We like to think of ourselves as audacious. Others in the investment market may find us out of our minds. We're trying to facilitate impact at scale by activating capital at scale, but not in any kind of conventional or recognizable format. We're not out trying to raise a multi-billion-dollar monolithic impact fund that allows us to do lots of different things. Matter of fact, we're not even trying to build an investment firm measured on assets under management. We're trying to bend the curve, facilitating impact at scale by activating capital at scale based on a differentiated theory of change whose principal step is something we call replication. The simple explanation of that is if we do something different that others view hard, and others are not pursuing, and we get the intended outcomes, both impact and financial, it is likely that others will try to follow us. And that's how we get the replication. That's how we activate capital at scale. In short, we're trying to pave the way for our own competition.
Interesting that you don't pursue assets under management model. What is the business model? How are you making money?
The ultimate hope for myself and my other partners and principals is that each one of these platforms that we stand up does scale to a point where not only does it carry its own weight, but it generates economics consistent with the necessity to make sure that we're constantly building teams of high-powered quality individuals who have the capabilities and skill sets to deliver great performance in the platform. So I will say up front that we are not typically non-concessionary investors. Our belief is in order to get impact at scale and activate capital at scale, it means that you need to honor the sanctity of the risk-reward relationship to unlock institutional capital. And so therefore, everything that we're doing does follow the similar expectation in terms of return on effort. But we as founders, we as seed investors take a much more patient approach to getting to the end line.
Bob, let's make this more tangible by learning about 3 projects that you're driving today. First, Sustainable Credit Partners. Before we get into what SCP is, tell us about the problem it aims to address and what's at stake.
The big picture for SCP is it operates within the built environment, and more specifically, commercial real estate, and more granularly, the mid-market commercial real estate market, which here in the U.S. is a $21 trillion marketplace. What is the mid-market? It's buildings that are worth typically $100 million or more. It is all the buildings that you see as you live your life that are not big, shiny, glitzy new projects. The vast majority of that mid-market is aged. And as a result of that, are not up to current standards in terms of energy efficiency, sustainability, and adaptation, getting ready for climate change. That's a big, whether you're looking at it from a climate change and a decarbonization standpoint, that's a big issue, the age and the lack of updating of these buildings. And it emanates really at a commercial necessity. If you own a building today, you are competing for a finite pool of tenants. Those tenants represent cash flow. That cash flow represents value that is recognized by not only investors, but lenders. And so therefore, part of your task as an owner is to maximize the cash flow. In commercial real estate, one way or the other, the cost of energy, the cost of insurance, and other costs flow through to the tenant. And so if your building is not up to snuff in terms of energy efficiency, that comes out of the tenant's pocket one way or the other. And so building owners are being forced by market forces to bring their buildings into a new level of energy efficiency. And that's become increasingly relevant today when you have spiking utility costs driven first and foremost by demand, whether it's coming from AI, data centers, or others, and exacerbated, obviously, by the disruption of the supply chain coming from the Iran war. So the short story is what SCP does is it helps decarbonize the built environment, which produces 40% of carbon emissions worldwide, by providing the financing to a big sector of that built environment to retrofit the buildings to make them more energy efficient, and thereby reducing the carbon footprint of that building. That's the high level of what SCP does.
Let's get into the nitty gritty. How do you do it? It seems like obviously an important, large task that affects millions of buildings. And I can't even imagine how many tons of CO2 and incredible financial stakes as well. So let's get into how this actually works in practice.
Yeah, that's an important question because the average commercial real estate owner is not known for their greenness or their philanthropic commitments to the environment. So it really does need to make dollars and cents for the borrower. So the first thing that we do is we make this very simple. Our lending program from SCP is easier, cheaper, and faster than any other widely available financing in the market. I can go into that a little bit more deeply in a minute. But borrowers for commercial real estate really care about three things. They care about interest rate, they care about the proceeds of the loan, and they care about ease of execution. So we have been very deliberate to build our business to check each one of those boxes. A borrower owns a building. They come to us for a loan. The kinds of loans that we make in the commercial real estate market are known as bridge-like loans. They're typically 3-year floating rate loans intended to transition the property from point A to point B. In this case, the point A and point B is defined by that retrofitting requirement. So the borrower comes to us, they apply for a loan. We deploy two kinds of teams to do the underwriting. The first is the conventional fundamental underwriting for making a commercial real estate loan. And the second is a dedicated effort where we send out a team from our strategic partner, GreenGeneration, to audit this specific property for opportunities to make the building more energy efficient and generate a bespoke game plan for specifically what needs to be done to this building. Typically, that plan has multiple elements. Those that we view are a requirement for our loans. And the other is intended to be a shopping list of long-term opportunities for the borrower, where the borrower can pursue that over time, even after our loan is paid off. We believe that we're not only in the financing business, but we're in the education business. We're trying to educate these borrowers on the benefits, the process, and the pathway for constant improvement from an energy and sustainability standpoint. The loans that we make are very simple, very familiar loans where only a portion of those loans is attributable to the value that we are recognizing from the retrofit. The balance of the loan is typically used for the borrower from a refinancing or an acquisition standpoint. And importantly, it's a one-stop shop single loan. Other financiers in the space, most notably a program called CPACE, is structured in a very complicated loan over loan scenario with a complicated lien, which the borrowers typically struggle with in terms of the complexity, the time, the cost, the necessity of getting the senior lender to sign off on this new loan, the CPACE loan, on top of their own. Ours, what we want to do is just, again, make it very familiar to the borrower, seamless, and, meet the market where it needs and where it is, I should say.
How's it going? How long has the program been in execution, and how many loans and what sort of volume have you been able to do?
The program is designed, we believe that when we hit full stride, we'll be doing $1.5 billion to $2 billion a year in annual origination. Right now, we are targeting for this year, which is our first full year, for $500 million of origination. We started the business in the early third quarter of last year. So much of that period of time was building brand and getting people to know and understand us. We're now quite happy with the volume and velocity of what we're doing. The beginning goal was to be doing at least one loan a month. We're heading towards 2 loans a month. And we are attracting not only an increasing pipeline of lending opportunities. But importantly, we're also attracting capital from big institutional investors who will really fund the potential scale of this project. From the investor standpoint, they're looking really at two things. One, they're looking at investing in our pools of credit and the return on that, and that is in line with the market and what they're getting from other similar credits. But importantly, if you're a big insurance company or pension fund, you have a large exposure to commercial real estate credit, embedded in your existing portfolio is something called the Brown discount. It's the risk embedded in these properties of values declining because of the lack of retrofitting with the buildings. And so, in short, if you are a institutional owner of CRE credit, our loans have the benefit of mitigating that Brown discount risk versus other similar loans that they may invest in.
And Bob, just to clarify, you said $100 million size buildings. What's an average loan for you?
Yeah, we expect the average loan size for us to be, $40 to $50 million over time. We will do bigger deals. So, for example, we have looked at loans as big as $150 million where the collateral is a pool of several properties. But when we look at a singular piece of collateral, it's typically $100 million or less.
And your differentiation in entering this market, I'm sure it's not just that you saw the opportunity, you saw the problem. Is there some expertise or something that makes you uniquely capable of writing these loans and evaluating the opportunities?
Yeah, I'd say there's three things. First and foremost, from the market-facing standpoint, how we interact with borrowers, it's a no big deal thing. We look and feel just like any other lender. That's really, really important because our approach to decarbonization is predicated on our belief that the number of commercial real estate assets in the U.S. that can realistically achieve net zero is very low, very, very low. And so the quest to bring buildings to net zero could be very frustrating, long, and with questionable outcomes. The ability to reduce the carbon footprint of many buildings, 20 to 30%, is very real. And so if you measure by tons of carbon that we're taking out, our program is designed for the masses. So it starts with first, what's called superpower, is when a borrower talks to us, we talk back to them in a language they understand. The second thing that we do is we have a empathetic pair of strategic investors in SCP. One of them is GreenGeneration, which is a Washington, D.C. global leader in engineering, procurement, and construction, specifically to the commercial real estate retrofit market. This is the group that defines the blueprint for a specific building and oversees the work for the retrofit and then signs off on the completion of that. They are an important part because they are founded and run by commercial real estate people. And so again, they're coming in and speaking the language of the owner. We've also taken the framework developed by SCP and GreenGen to Moody's investor service and got that rated. So from a standpoint of the investors in our paper, including our eventual expectation to start issuing green CLOs, there's a second party opinion validating the validity of our framework and the fact that there's no greenwashing going on. The other strategic partner is Climate First Bank, the nation's only non-government aligned green bank. They exist solely to help with a climate transition. And so they've been a great partner. The third superpower that we have is we are still very much in the middle of an epically large wave of loan refinancing. And so the market is very good in terms of refinancing demand, and our ability to play in that market without complication has been fabulous.
Bob, I'm going to take you for your word on the idea that's one of your success metrics and one of your paths to scale and sparking competition. And so I'm curious, who else should be pursuing this model? It seems like the demand and the overall size of market is enormous given the existing building stock. Who else should be getting into this game?
So our pathway here, our Conduit Capital's role is to innovate, incubate, seed, staff, and launch these products with the expectation based on our commitment to collaboration that we will bring in other market players that will help facilitate and accelerate what we're doing. We're now at a point with SCP that we feel that we're past proof of concept because we've done several loans and our pipeline is there. Our processes are sharp. Our reputation amongst the borrowers that we've already served is high. We even begun engaging in conversations with several global institutional investors to provide us the access to capital to take SCP to the next plateau. Those providers or purveyors of capital do so through multiple lending channels. So we're hoping that they will commit the capital to us to bring us to prime time, if you will. What do we have? We have a substantial first mover advantage in the business model and the loan structure and the Moody's ratings and other things that we have done. But, we would expect and we would hope that other lenders would begin to lend in a similar fashion. Our mission has two goals. One is to decarbonize commercial real estate, so the more the better. And the second is through how we've approached our lending and how we've achieved the Moody's rating to also be able to add to the existing momentum for the green bond market. The thought will be that if we are generating the outcomes that we expect with SCP and we start originating volume and velocity, that will be able to package those loans into green CLOs. And, we still live in a world that in certain green bond markets, the pricing for that paper is inside comparable credits. And that's our expectation to tap that and then to be able to pass on that pricing advantage to our borrowers as a way to stimulate more lending and more decarbonization of the sector.
Fantastic. Let's move on from buildings to SPACs. Your second initiative is the Climate Transition Special Opportunities Partners. Let's again start with the problem that you're addressing.
Let me start by saying that my partners and I have historically been vocally SPAC skeptics. Our view of past vintages of SPACs is comprehensively complex, but I can summarize it by saying we think the idea of a SPAC as a corporate finance tool is very interesting and very valid. Like a lot of corporate finance tools, at times they have been ridden hard by those who have different intentions. And so we recognize that the history of SPACs is a bit checkered. Our willingness to use these vehicles started building late last year after the change in the political climate started to affect the capital flows to what we broadly define climate transition in the private market. Simply said, a lot of really, really good companies that, again, were past their proof of concept, were growing, were having an impact, et cetera, started to see their growth curves curtailed by the difficulties of raising capital. And we saw it whether it's a company that thought they were going IPO and found that the IPO market was no longer there, or companies that were on their C or D rounds who had to live with the fact that valuations were dialed back and so were proceeds. So we had a private market that was sliding backwards while we had a public market that was powering forward, creating this valuation gap between private and public markets. And we started to think of how we can create, and I use the term lifeboats. That may be unfair in terms of things were not that dire, but the general idea was that we would create this gateway tickets for the best and brightest private companies within certain sectors of climate transition, to take them public, to be able to access not only the capital that they needed to continue to grow, but also to give them the currency to be able to be the foundation of a roll-up in a sector. So getting more companies in the same lifeboat, and that currency being the shares. So what started out to be what we would view a classically defined special situations opportunity has morphed in the last couple of months to an accelerated opportunity for some of these companies to go from playing defense to playing offense, especially as it relates to the evolution of energy. And as we know, oil has been trading north of $100 a barrel for some period of time. One could argue that we've had a refresher course on the importance of energy security, which includes diversified sources of energy. And we're also experiencing, obviously, a massive increase in demand being driven by hyperscalers and others adjacent to the AI boom going on right now. And so there's this great opportunity. There are many stranded assets and stranded companies in energy generation and renewable energy that can be hastily brought forward through the use of these SPACs. So we set about, as we always do, to look at creating a new way to do things that was not solely based on, marshaling our own capital. We've pulled together a group of exciting impact investors to create the sponsor for not only the SPAC that we took public yesterday, but a series of these SPACs. Each one of them will likely have a very narrow theme that goes under that broad umbrella of climate transition.
Fantastic. Yeah. So we're recording this mid-May, and you just announced or went public with the first of these SPACs. Give us a sense of what that one focuses on and the types of investments you expect to make.
So the SPAC sponsor entity is called, as you mentioned, Climate Transition Special Opportunities. And underneath that SPAC sponsor entity, we have 9 specific themes ranging anywhere from energy generation, energy transmission, AI for energy, but also under that is industrial, the broad umbrella is industrial decarbonization, specialty finance, regenerative agriculture. This first SPAC that listed on the New York Stock Exchange yesterday is called Energy Transition Special Opportunities. And as the name gives you the sense, it's much more focused on energy transition, energy evolution. And in the pipeline of deals for that specific SPAC, we have a couple of very interesting companies that I would define to be in the specialty finance sector. They are purveyors of capital to the energy transition space. So us investing in them acts as a multiplier because they attract other capital to on lend or on invest. And we also have some very interesting companies that we're looking at that is in the e-mobility space or the powered land space. While there are other things that we're looking at right now in the pipeline for that SPAC, those represent a couple of the sort of prime merger targets that we're evaluating right now. We do anticipate doing, as I said, under the climate transition umbrella, other SPACs. What is increasingly becoming interesting to us thematically for the second SPAC is regenerative agriculture. I can't say much more than that because, there are guardrails around these publicly traded vehicles, but directionally, that's where we're going.
I actually wanted to ask about regenerative ag because the inclusion of regenerative agriculture in the first SPAC is notable and interesting and exciting that it's going to be in future SPACs as well. Obviously, there's a lot of impact potential there, but from an economic lens, why include regenerative ag alongside energy transition and finance? What can you share about the financial profile of firms in that space?
That's a broad question because the idea of regenerative agriculture spans anywhere from the dirt to technologies to distribution, et cetera. I can say broadly speaking that for any of our strategies to work, they need to be commercially viable. As I said on the onset, in order to get impact at scale, you have to activate capital at scale. And the only way that you get capital at scale is to meet the market's risk reward relationship. And so, we are looking at technologies that are commercially viable, that help farmers be more efficient and more sustainable, dealing with real issues that they have on the ground, ranging anywhere from testing of soil composition to cleaning their aquifers and water sources. Amongst our partners, we have one partner who is leading the effort on the regenerative ag, who can probably answer that question more specifically. But thematically, food and water is pretty important to us, right? And it has been well reported that the change in political winds has had an effect on rural communities. And a big part of that includes the agricultural community.
Bob, let's turn to a third project that you've been leading, the Pioneer Gap Alliance and the Pioneer Gap Impact Platform Fund. What you're calling the Pioneer Gap overlaps at least a bit with the Missing Middle, which we actually ran a 6-episode series over the last year in partnership with Spring Lane Capital. So definitely a topic I'm interested and familiar with. How would you describe the problem of the Pioneer Gap?
Well, first and foremost, let me be honest and say that you and your podcast and Spring Lane were a bit of a muse, for this. And I think I actually reference this in the white paper that we wrote several months ago on this. But you're right. Other people will recognize this problem either by defining it as the missing middle or the valley of death. And both of them are accurate. And actually, one of my partners forbid me to use the term valley of death because it was too negative. And missing middle is kind of already taken and it's understood to relate specifically to individual companies. But the principle, shared by the missing middle, the valley of death, and the Pioneer Gap is very simple. It is easier for an entrepreneur to raise that initial capital needed to get going for an idea with a pitch deck and energy than it is for that same entrepreneur to raise the next round of money after they've started, had proof of concept, and have visibility of either the starting line or the end line for commercialization of the product. It's a really interesting psychological thing for me when I think about it. It probably emanates from the fact that after you've gotten started, those investors in the next round actually can judge you. And when they start to judge you, they've got more to go on, right? And that, as they always say, in order to attract investment capital, you need to answer 100 questions right. And if you answer one of them wrong, it doesn't end well. There's more granularity to judge. You, Spring Lane, have discussed what it's like to be an entrepreneur, starting a company. What does it look like from a VC perspective standpoint? And it was interesting when I was listening to your podcast, I had this epiphany is Conduit Capital lives in that missing middle or that valley of death, but in a different way. We are entrepreneurs of innovative financial solutions for impact. We're not necessarily building individual companies with products. We're building platforms that may be investing or lending to some of those entrepreneurs, but we're entrepreneurial in the sense that we are creating platforms that have no peers and no precedent. As with all our initiatives as Conduit Capital, we identify a problem, we frame out a solution, and we put a new name to it, and we go about accessing our network to create a collaborative approach to creating a new product.
Well, let me jump in there, Bob, because you've done more than put a new name to it. And I think you're being a bit humble, but with this particular program, you've started the Pioneer Gap Impact Platform Fund, and it's a new tool. It's a blended finance tool to help fill the gap. And I think it reflects the type of collaboration that you spoke about earlier, and that's core to your model. So give us a quick sense. What is this new fund, and what are the different types of investors that are getting involved?
Well, it's more than just a fund. We hope to actually create an alliance around this idea, similarly to what we did with the Climate Transition Special Opportunities Partner SPAC sponsor. In all products, don't look at things being a one and done kind of thing. What we're really trying to do is bend the curve, and it's easier to bend the curve with help than just one group. And so, as you mentioned, we see the Pioneer Gap as being a collaborative alliance that together sponsors a series of Pioneer Gap funds. The funds themselves would be a blended finance product. Within the fund, we'd have 2 to 3 types of or flavors of investment capital. The base layer will be a catalytic capital provider. The middle layer will likely be a mezzanine kind of return, kind of risk. And then the third will be a market-based GP/LP kind of investor. We like to see within this alliance 1 or 2 premier names in the catalytic capital world, and the other players will just come naturally because of the relationships that we have. As you know, several weeks ago, we published a white paper called, focused on the Pioneer Gap. We've been blown away by the response that we've got, not only to the published article, but the conversations that we had with potential partners. And so that process just began. It's moving quickly, and it's something that we hope to crystallize in the next couple of months.
Exciting, particularly that for those catalytic capital providers, it's in some ways doubly catalytic because they're both catalyzing and crowding in funding for a particular fund that they're participating in, but then they're also providing momentum for the platform itself, which will spin up additional funds. So I see the outsized impact there.
Exactly. And for many of these catalytic capital providers, they know this issue well. They didn't know the name of it because we put the name on it, but they know this issue well because as a catalytic capital provider, they're often the first investors in some of these first-time funds. And so they see it in their existing portfolio. So what we're hoping to do is to work with them to help us help them.
Bob, this has been a fascinating conversation, and I applaud the ways that you're activating capital at scale, as they're not just creative, but also clearly designed to meet the moment and the particular challenges and opportunities the market brings today. So let's leave off quickly with your thoughts on this moment. In one of your white papers, you saw this could be the best of times for climate investing. How do you see climate investing in this moment, and what needs to happen to realize that potential?
I actually think it is the best of times for climate investing. It starts with the fact that much of the rest of the world has never lost stride and has kept momentum and doing what they can for energy and climate transition. And I think here in the United States, last year was a really important time for all of us in the climate transition because it forced us to go back to the principal reality that what we were doing needed to be less about talk and debate around measurement and more focus on the common sense need for what we're doing and how it affects actual people and how we need to respond to the investors that provide us the capital. So, last year, the narrative switched from focused on the green narrative and, an existential threat to bringing this into a manner that I think more common people could focus on. That is one. I think those who survived last year are in the market with a new respect for the commercial realities and necessities of what we're doing. The second thing that I think has happened, again, is ironically the same stimulus of the political change last year has actually become the best friend of ours in the fact that through the activities of the last couple of months and the issues at the Strait of Hormuz and the breakdown of global supply chains, that layered over a demand spike for this macro event called AI has made the reality of the need for these new energy solutions ever more present. And so I think it's a great time to be doing these things. My number one hope is tied to my number one concern, which is we lose the moment because, again, we get lost in the narrative and too much talk and not enough action. And we get too bogged down in the long-running debate of impact measurement and so on and so forth. We know what's impactful. We need to know what we need to do. This is the moment to do it.
Fantastic. Bob, thank you so much for your time today. All the best of luck with these 3 initiatives and surely many more that you're working on.
Jason, thank you for what you're doing, and it's been a pleasure to speak to you today.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.